What is up, everyone? So in this video, I'm going to show you guys why I think the US and the world economy is about to enter into a recession and how you can protect yourself from that and even make money from it. Just recently here, last 2 days, Atlanta Fed has come out with their quarter 1 forecast for GDP, and it came out at 0.14%, which is quite astonishing because just a half year ago, we had GDP around 4 or 5%. And just in the last 6 months, it's slid from all the way from 4% all the way down to 0.14%. And even this, I think they might be overstating this a little bit. And I've already gone over in the last videos how a lot of economies around the world are really starting to slow very quickly. China, Europe, Australia, all those countries are really starting to slow, and that's starting to reflect in the US as well. We've kind of lagged a little bit, and we haven't slowed down quite as quickly as some of the other countries. And I do think that we're going to be more insulated than countries like, or regions like Europe, China, Australia. And real quick, I'll define what recession is. So recession is 2 consecutive quarters of negative growth. And honestly, like I said, we don't even have to enter into a recession for the market to go down. If you look back in periods like 2000, 2001, we had positive yearly GDP growth. We had, a couple quarters of negative growth, but overall, for the overall year, we had positive growth. And the market declined quite significantly, 20-30% plus in the S&P 500. NASDAQ, that's when, the tech bubble blew up. 2007, we had positive GDP of like 4%. 2008, we had negative 0.1%. And then 2009 is when we had minus 2.4%. And this is why in my other videos, why I have been going over PMIs, not GDP, because GDP is really a backwards looking tool to measure the health of the economy. PMIs are really a leading indicator. And this is shown back in 2008, like I said, when we had positive growth back in 2007. That's when the market started to go down and started to sell off. So you wouldn't have thought that we would have been going into a recession with positive 4% GDP growth. In 2008, we had just slightly negative 0.1 overall yearly GDP growth, or decline, I guess. And that's really when the market tanked. End of 2007 going into 2008, and then 2008 to 2009 it started to rebound, but 2009 is when we had the minus 2.4. So that's why you don't want to look at GDP, because that's always a lagging indicator. That's old news, that's happened in the past. Your job in the financial markets is to predict the future, and that's how you make money. Simple as that. So now we'll go and jump into my computer, and I'll show you guys 20-year chart of the S&P 500, and also the yearly growth rates for GDP, just to kind of illustrate even more so just how backwards looking GDP is, and how that's something that you really don't want to look at. You want to look at PMIs because that is a leading indicator. And again, like I said in my last videos, PMIs around the world have been just plummeting. South Korea, which is the main one, China, Australia, Europe, all those countries, the PMIs have just been plummeting over the last few months, really. So we'll go ahead and jump into my computer, and I'll show you guys a few charts to help better illustrate this. Alrighty, guys, so this is a 20-year chart of the S&P 500. As you can see, this back in 99, 2000, the start of 2000 is really when things started to go down. As you can see, this wasn't like 2008. This was a much more gradual bear market. And like I said, so it started 2000, 01, 01 to 02, and then 02 is when it started to rebound. And then back in 08, it happened a lot quicker. So 07 is when things kind of started to go down. And then end of 2007, that's when shit really hit the fan. Beginning of 2008 is where we had the bottoms, and then it rallied from there. So from this chart, you would think, 2007, we had an awful year. in the economic wise, that's what you would think, that GDP would be just abysmal, but that's not true. The market is forward looking. That's why, like I said many times, GDP is a lagging indicator, and this will be a great depiction of this. And also real quick, where we are now, just monster rally back from '08, high around 293. We had a sell-off a few months ago, December, and we've rallied quite a bit back from that. And this is where I'm, starting to add back to my shorts. But we'll pull up the GDP chart here real quick, and this is by year. Pull this over here. So from 2000, that's when things kind of started to go down gradually. But as you can see, we never had a negative year of GDP growth. And that's why I say we don't need to have like an all-out recession, anything like that. Like, oh wait, that was pretty bad. But as you can see, from 2000 to 2002, we had a decline from high of 155 about to a low of about 80. So in 2 years, it declined about 40%, give or take. And that's with us never having a negative year of growth. So as you can see, 2000 kind of grew 4.1%, 01, 1%, 02, 1.7%. So we never even had a year of sub 1% growth. And, 2000, like I said, had amazing growth in 2000. But that's when the stock market started to go down. 01 took a hit, pretty poor compared to the year before, but not negative. And we still went down, like I said, from here to here, about 40%. 02, 1.7%. And then we'll go to back in 08. So 07, market topped around 155, had a low of 67. So market more than halved about a year's time. And so we'll look at the GDP for 2007. We had 1.9, so not amazing, but not negative. And that's really when the market fell off, was 2007. In 2007, and really by 08, it had already bottomed and started to rally. So we look at 07, 1.9%. 08, we had minus 0.1. So not awful, but it is negative. And that's when we bottom, was beginning of 2008. 09 is when we had the awful year of GDP growth, minus 2.5. But as you can see, the market rallied 2009. From beginning 2008, 2009, all the way till now. Comparing these two charts really just depicts this perfectly, because it shows how backwards looking GDP actually is. And if you'd had looked at the end of the year GDP in 09, the market would have already rallied from 67 to 115. So like 30%, 40%, you would have missed 30-40% right there. So that's, like I said, your job in the market is to predict the future and think about what's going to happen next, not what's happened in the past. That's your only job, and if you can do that right, you'll make money. So how can you protect yourself from this and even make money from this? Well, as far as going long stocks and buying stocks, I would be very selective with what you are long. I don't suggest being totally out of the market and selling everything that you have, because you never know. I mean, we could rebound. You can never predict these things 100%. Otherwise, we'd all be a millionaire, and we wouldn't even have the stock market, because everything would be perfectly predicted. So what I would suggest, or what I am doing, is I'm very selective with what longs I have. And then I'm also selective with what shorts I have. I'm not just out there shorting the whole market. In my previous videos, which I'll link down below, that's where I go into some of the shorts that I have on. And what I'm looking at is Australia, Canada banks, because I believe their housing market is very overvalued, and I think it is about to pop. Also, anything related to China. Australia is very heavily influenced by China. That's also why I'm short Australia as a whole and their banks. I also have quite a bit of money into CDs. My best rate is 3.4%, and that's guaranteed no matter what happens. I get 3.4% every year, and I sleep very well at night, knowing that I get that constant return. I don't have to worry about anything. It's not much, 3.4%, but it's guaranteed, and it's better than losing money. So yeah, that's it for this video, guys. I hope you guys enjoyed this. The hardest part of investing is timing. Timing is everything, and that's the hardest part. You might know something's gonna happen, but actually timing it is like 80% of it, is especially with options, because you're paying theta. So you're paying for time, because if you buy an option that expires 3 months out, it's going to expire worthless in 3 months if you're not right by that certain time, 3 months. So that's why any rallies that we have, that's where I'm kind of looking to add to my shorts. And most of my put options that I have are 5 to 6 months out. So yeah, that's it for this video, guys. I hope you guys got some value out of this, and I'll see you guys in the next one.